stimulus, we believe that employment and inflation would likely ease relative to our targets. Hence, we've taken the action we've taken today. Global economic activity continues to weaken, and that is easing demand for New Zealand's goods and services. Heightened uncertainty and the declining international trade have contributed to this lower trading partner growth. Central banks are certainly aware of these issues, and they are easing monetary policy to support their economies. Having said that, global long-term interest rates remain historically low, and they are projecting ongoing low inflation and growth, if they stay at these low levels of nominal interest rate. In New Zealand, we see low interest rates and increased government spending being able to support a pickup in demand over the coming year. Business investment is also expected to grow given the low interest rates and given some ongoing capacity constraints. Increased construction activity will also support economic activity and the pickup in demand in New Zealand. Our actions today demonstrate our ongoing commitment to ensure inflation increases back to the midpoint of the target and that employment remains near its maximum sustainable level. We are forward-looking, the country is in a great position, and monetary and fiscal policy are operating as one would expect based on our mandate. Mai Taki, thank you very much, and we're open for questions.
Hi, just a couple of questions. This 50 basis point cut today is larger than what the market was or the forecasts were expecting. So does this rule out any further cuts this year? And the second is there's a lot of emphasis in the statement about the global escalation in trade tensions. So could you just elaborate on how the U.S.-China trade tensions will affect the economy here and decisions?
Wonderful, wonderful. So no, today's decision doesn't rule out any future action. Our forward path, as you can see, provides a good guidance as to where our best guess, it's a one single draw of the card as of today, of how we see the interest rate path unfolding, and that forward path was there or thereabouts to what markets were pricing. So nothing is ruled out for the future. In terms of the global trade, we talk at length in our document. I mean, there's three broad ways. The first is the obvious through demand for goods and services of New Zealand. With global trade slowing, that means less demand for our goods and services. The other one, of course, and probably the most interesting one, challenging for all central banks, is the financial market channel. With central banks operating globally, easing interest rates, long-term nominal interest rates have come down, and so we are in a low nominal environment. Monetary policy is still just as effective at low interest rates. It just means that, that you are operating around a lower neutral interest rate. And I think many central banks have been increasingly coming to the realisation that they have declined. The number one challenge for us, though, is the one we know least about, and that is business behaviour. And with the uncertainty rising around what is happening, particularly the US-China trade tensions, business uncertainty can be paralysing to investment activity. And so we are seeing increasing concern as uncertainty lingers. It is holding up investment decisions.
Just further to that business sentiment channel, isn't there a risk of an own goal here that people might look at this and say, it must be worse than we thought, because they haven't, after all, been citing the cost of credit as what's been holding them back? What makes you think this will have a positive effect there? And as a second question, as far as household consumption is concerned, you seem to be more concerned about the wealth effect than the risk that you're reigniting house price inflation when we've had too much of that already.
Yeah, thank you. Two very good questions, and questions that were very debated during our week and a half of deliberations. The first thing to note is that inflation, excuse me, and employment are our targets, and interest rates are our instrument, and it makes complete sense to be using our instrument to make sure that we hit our inflation and employment targets. So lowering the interest rate is completely sensible at this point in time. Holding an interest rate back in case you needed to have more in the future just makes no sense whatsoever. So we're comfortable with that. Around the interest rate, lower interest rates mean a few things. One is that debt levels are more sustainable. It also means that investment hurdles are now lower, further reducing any kind of barrier to wanting to spend or invest for households, for businesses and for government. And what we're implicitly saying here is that lower interest rates and those people who want to spend, invest, will outweigh those who might have lower earnings off their bank accounts. On the house side, again, we have been nervous about the extreme levels of debt for small pockets of households. We are much less nervous about that now, having had our LVRs in place and having seen those debt levels evolve through time. Can I, am I missing any nervousness, Christian?
No, not at all. I just pick up on the point about the effectiveness of monetary policy, and we do get this asked to us a lot given where debt levels are. And a key aspect is the transmission mechanism for monetary policy has many, many branches. So there are channels that are still working. And we have looked at the effectiveness of monetary policy both before and after the GFC in high and low interest rate environments. And the key message that we're getting from that research is that monetary policy is still effective, and that's really what motivates our actions today.
Thank
you. Just pick up on the phrase that you used in the previous MPS, which was that you were getting ahead of the curve. Is this 50 basis point cut an example of that, as you sort of front-loading stimulus for the economy? And ancillary to that, what more does the government need to do in terms of fiscal policy that would assist monetary policy?
Yeah, I'll start answering those from the back to the front. The good old phrase, monetary policy always needs friends. At this point, it needs friends around all parts of the economy, consumers to be comfortable, businesses to invest, and of course, government to be spending. And government in this forecast, this is the first prediction that we have fully taken on board the most recent fiscal policy statement, and you can see a significant positive impulse from the planned spending activity. There's spending, there's investment, there's the transfer payments that are all acting as aggregate demand drivers. So it's a positive story. Our nervousness, and it feels quite unusual for a central banker to be saying this, our nervousness is that expenditure can't happen quick enough. I.e. with capacity constraints where they are, with the economy operating very well, finding the space to increase the investment and spending is a challenge, but it's a quality challenge. And I've dutifully forgotten the first question, Giles. So.
The first one was, is this an example of you front-loading?
Yes.
Getting a bigger shot now and perhaps might miss
It was a really interesting discussion we had with the committee, and you can see towards the end of our record of the meetings that we sat there and tossed and turned around one plus the forward guidance, which would have another one and possibly something else in the tin, or two now with possibly something else in the tin, and the pros and cons of doing it. Over recent days, it's become increasingly, the committee became increasingly convinced that more sooner is a safer strategy to achieve our targets than slower for longer. And in a sense, it's around the regret analysis. In a year's time, I would far prefer to be sitting here with the quality problem of thinking, wow, inflation expectations are getting away on us. We might have to start thinking about other activity. That's a much nicer challenge to have a monetary policy than doing too little too late.
Governor, you said that there's some positive fiscal stimulus from the government that you've got in these forecasts, but the Treasury's fiscal impulse numbers for the next 3 years actually show the government detracting from economic growth by about 1% of GDP. Do you think the government should do more than it's currently doing to be a mate?
We can only take what they have provided, and from what I understand, they are working very hard with all available opportunity. But on the impulse side, Jung, do you want to chat a little bit about it?
It's unequivocal that the government is actually spending more. So the fiscal impulse measure, there's a lot of things that go into it, but from our end, it's clear that there's additional fiscal stimulus factored into these forecasts compared to 3 months ago. So fiscal policy is actually doing its bit to stimulate the economy.
And that's particularly over the next 12 months or so. That's where the stimulus and the impulse is the greatest, and then it wanes from there.
Governor Philip Lowe in Australia actually called for more fiscal stimulus from both the states and the federal governments there, particularly around infrastructure. What would you say to central and local governments here about infrastructure spending?
Well, I have to say we're in a positive situation that we have a different fiscal authority, in the sense that our fiscal authority is already being very proactive on spending and investment. I do believe that it's imperative that that money is spent. It's even great if it's spent incredibly wisely on long-term infrastructure. Part of having lower interest rates mean the hurdle rates of return to investment, particularly long-dated investment, which a lot of infrastructure is, those hurdles are much lower. And it is a fantastic global opportunity to be putting in a lot of that long-term infrastructure activity. The challenge, of course, is over what pace can you do that, getting the resources, etc. What can come faster is just straight spending, i.e. putting money in the hands of people, and government's own consumption, i.e. through hospitals, schools, etc., that type of activity. And so, you know, from everything I hear, and certainly our Treasury Observer has been very useful in helping us understand the inside machinations there, the foot's on the accelerator.
Thank you. A couple of questions. Just back to the 50-point cut. I think the last time the RB cut by 50 points was after the Christchurch earthquake, and I think some people will be asking, what is it in the current environment that prompted such a move today? Is there anything in particular that tipped the balance in favour of 50?
No, it's been a slow-moving challenge. Certainly, we got to a position as the Monetary Policy Committee, and where lower interest rates were clearly needed. And then it was more of a, I suppose, just a strategic discussion around regret analysis. I absolutely agree that people go, wow, did they know something that we don't? The answer is no. You have everything that we've looked at. We are, we lead the world on transparency. We are using the data you've got. Everything that we've considered is in the monetary policy statement. I do want to commend our economics team. I hope you've noticed the new format for the monetary policy statement. It gets more and more difficult the further you get in, where you can look at a lot of those relationships. So no, there is no hidden variable here. The mere fact is that global interest rates have been declining, and we're part of that cyclical behaviour. Global interest rates are at a secular low, not even a cyclical.
It just quickly then on that inflation expectations number yesterday, was that of any? How much weight would you put on that? Did that give you a bit of a fright, or?
No, I mean, it's great that it came. Well, we had the labour market data coming out the same day. It's never a perfect day to seal the forecasts and make decisions, which is why the final decisions were done today. But again, as you'll see in the record of the meetings, some members were quite illuminated around the lower near-term inflation expectations, which had come down a reasonable size, whereas other members were more comfortable that the 2-year, 3-year, 5-year inflation expectations have barely moved. But that does sit as one of the risks that we've been balancing, which is why action now is better. We don't want to be having headline inflation slowly dragging down expected inflation, and if we move too slow. So part of today is, wake up, go and spend.
So just finally, now that you're down at 1, there's obviously inevitably discussion about potential use of non-standard measures. Are you able to tell us what your thinking is on that? You're clearly doing some work on it. Do you see that as a realistic risk? Where are you at on that work?
We are well advanced on the work. That work, of course, is confidential to the Reserve Bank because it has implications for markets and pricings. But we would be negligent not to be doing the work where how we do negative interest rates, how we might do asset purchases, how we might do forward guidance different to just our forecasts, how we might do other forms of intervention. And so we are looking at the full tool suite. We're working very closely with our Treasury colleagues as well, because some of it is fiscal policy operated through a monetary institution. But without doubt, globally, when you're looking at Europe, Sweden, Japan, all with negative interest rates, and with us at 1% and many other economies below 1%, it's easily within the realms of possibility that we might have to use negative interest rates. The important thing to remember today is that by doing more sooner probably reduces the probability, I don't know by how much, of having to do that. It means we're using our tools effectively.
I just have a question about the statistical tables at the end of the MPS. The one that has key forecasts has the OCR at 1.4% in September, and then dropping down to 1.2%, 1.1%. I'm just wondering why those forecasts are at those levels.
Jung?
Well, basically the forecasts show a position where more monetary policy stimulus is needed, and that's in the quantum of 50 to 60 basis points, and that's the basis we as a Monetary Policy Committee debated on and agreed with, and then the decision about when to deliver that stimulus, how much, how many steps, that was the decision we've made today around tactics.
And I think a little bit as well is that of course is just taking averages on the way through, whereas we're talking about quarterly points when we talk about the OCR.
Could you just expand on how your thinking might have changed in, say, the past week as different events around the world have sort of impacted global markets?
Our projections were very much forward-looking based on the information and material that's going on. I would say there's been some interesting sides. It's been hard to find upside events during the period. But having said that, again, we welcome the labour market data. To see employment growth and wage growth rising is a fantastic thing for us. But through the week, probably the single biggest challenge to us is just how low global nominal interest rates are. And so we're sitting in our waka here as Aotearoa New Zealand, but we are on a global ocean, and that tide has gone out in terms of the nominal interest rate levels. And so that, monetary policy is as effective, but it's still relative to some sense of a global neutral interest rate. And that has certainly declined. When you look at the long end of the US, the US 10-year bond yields, significantly below 2%. These are really, really interesting times.
I'd just add on the particular point around the data over the last week. We are conscious that we need to be disciplined and we need to take a medium-term view. And we are conscious that some of this data is volatile. So it'd be it's sort of unlikely that we'd ever be tilted by one particular outturn. We do need to look through into that medium-term outlook, and that's where the committee was very firm on its view of where things stood.
And just to really push that home, starting point uncertainty is just one of the uncertainties, i.e. what's it like where we are today? And a lot of data is already 3 months old. The next level of uncertainty is how is the economy working? And I'd say that uncertainty has been more dominating in the discussions, if we thought about that, around these neutral interest rates and trade behaviour. And then, of course, the last uncertainty is we might be surprised by anything between now and the next time we sit down. So it's about getting that balance. The good news is we're standing in a solid position. We're looking forward and acting preemptively with a effective monetary system and a fiscal system that can sustain increased spending.
Was the committee concerned that the banks may be reluctant to actually pass on all or even most of the cut, given the increased capital requirements? And was that a factor in the decision to actually cut it a bit harder now?
Absolutely concerned, not the capital requirements, I'll come to that separately because decisions haven't been made there, but certainly the pass-through of the official cash rate into retail lending rates has been quite a significant topic of conversation with the committee. It's a positive, first of all, we've said that the pass-through is no different relative to the past 10 years post-GFC. It is different to prior to that, but it's different for a very positive reason, and that is that banks are funding themselves more from deposits these days rather than just wholesale lending. So the official cash rate is largely the wholesale lending indicator, but they still need to convince mum and dad to leave deposits in the bank. And so the more deposits, the more interest in what they have to pay as well as what they can borrow at. And so it's been a positive side, but the pass-through is happening.
Given the importance of deposits.
Yeah, and just to reiterate as well, there has actually been one bank that has already fully passed through the 50 basis points into their floating rates, and so we'll be watching for what the other banks do.
Given the importance of deposits, given that you expect household saving rates to remain negative, given that already the returns to depositors after tax and inflation are pretty meagre and exiguous, what do you think the effect of another 50 basis point cut will be on the largest source of bank funding?
It's very obvious that the official cash rate and monetary policy is a blunt tool. We can't say we can't give everyone an individual OCR. The importance of an OCR is that it means that hurdle rates to investment change, i.e. they are currently lower, and it means that investment is needed. That's why we're doing it. Saving and investment are the flip side of each other. So if you're just saving and thinking you're going to get the same return year after year after year, that's never been the case and is not the case. So it's a matter of, if you're unhappy with the savings, the returns you get on savings, it's about thinking around what are alternative uses for my savings, i.e. what are alternative investments. And it's the alternative investments, i.e. putting your capital to work, is what creates the expected demand that we're talking about. We are absolutely convinced that the weight sits on lower interest rates means more spending, as opposed to lower interest rates mean less interest income and hence less spending. It is very clear that investment, consumption and government spending will far outweigh lower deposit earnings.
In the last few weeks, Governor, farmers in particular and some small businesses say that banks haven't been passing on lower interest rates to them, and that in some cases credit availability has tightened for whatever reason. Are you confident that this 50 basis points will be passed on to business investors just as much as it has been in the past, or should be, given that, maybe for a bank it's actually easier and safer just to pass it on only to home buyers?
No, that was in part, and I apologise, I didn't answer the second half of your question, but without doubt the transmission mechanism through the lower OCR and then to on-tail retail lending is something that we'll be watching closely. It is unambiguous that credit conditions have tightened for some sectors of the economy because retail banks' appetites have changed. And that has been particularly true for the agricultural sector. We hear about the small to medium-sized enterprise, but Jeff, it's not so obvious in the stats, is it? So everyone loves lending to housing, the retail banks, because they think that's nice and simple, and they don't have to hold much capital in their book to do that. But the banks themselves are looking at 10 years of seriously aggressive lending to the farming sectors, and they're all having a moment of consideration at the moment around what to do. That should be independent of the interest rate. That's about them trying to retain their customers, them being good citizens of this country for good times and bad lending to the agricultural sector. And we're having a lot of conversations about that. I know a lot of banks were wanting to, I suppose, effectively hide behind our possible changes to the capital ratios as their excuse to exit farming. But we've made it very clear that it's their issue that they've built that they need to work through with their customers. I will note, of course, that there's another transmission mechanism that gets money going to the agriculture and export sector, and that's the exchange rate. And so, a watching brief on how that drops to bottom lines, and what it does will be interesting as well for farmers. Remember, exchange rates are a zero-sum game. It's always relative to some other country, and many countries are wanting to use that channel, so we don't have a lever for it.
On that issue of exchange rates, there's been talk in the last few days about currency wars, with apparently China intervening, and some talk that America might. Could New Zealand be stuck out in the cold, or be the last one to get hammered in the game if we don't get involved in some currency war, or is it not something to worry about?
I believe it's something that we have to be aware of, but something that we can't do much about in advance, just simply react. I mean, the exchange rate level, the relative competitiveness, of course, is always an important financial transmission mechanism, or monetary transmission mechanism for us, but we have chosen to control interest rates and domestic inflation, meaning the exchange rate is out there being freely floating. Again, you know, it's not something we would be wanting to. I don't even know how you would actively play that game. I'm not sure that you can. Jung, do you know how to?
No, but it's also important to remind ourselves that the exchange rate has always played a useful shock absorber role for New Zealand. So, independent of what might be going on internationally, we still think that's an important channel for our country.
Good. Are we just about there?
Just a question about capacity constraints. Up until now, the government has allocated more money to stimulate the economy and invest in infrastructure, but it has actually struggled to get the money out the door. And in the latest budget, it's allocated more money, and I guess the thing that we're all a little bit concerned about is whether it'll once again continue to struggle to get the money out the door due to capacity constraints. So how can you be certain that fiscal stimulus will actually have the intended effect next year, as you know that those policies are meant to start taking effect?
You know, the answer is we can never be certain. We're following the intentions of the government. They've made it very obvious and put a lot of their reputational capital on getting the spending done. Some is quite immediate around the consumption. Others is much longer term lags around investment. But certainly they have put their flag on that mast that they are in expansionary mode. You know, so we're doing it. I will also remind people that the fiscal numbers that we put into our forecasts come from Treasury, and Treasury have already put a healthy dose of scepticism across those figures related to how quickly can you actually deploy. So rather than us double counting, we are comfortable that they have thought very hard about the ability to deploy, and those are the figures that sit in our forecasts.
Just the last one from me, Governor. You mentioned that you're considering your unconventional measures, and that as you do, there's the chance that essentially you're doing fiscal policy with monetary policy. Do you think, therefore, there's a role for a much broader public consultation, or even the involvement of the executive or the parliament in decisions about whether you do negative interest rates versus helicopter money versus quantitative easing?
I will say no, but we would certainly operate with no surprises. And so people get quite confused around what it is. It's the same Crown balance sheet. We would be working very closely. If you chose a particular form, negative interest rates, it's business as usual. We just got a bracket in front of the number. Quantitative easing, it's about us basically shortening the duration of a government yield curve. All of these things would have to be done with the full understanding of the whole of government, but it remains within the remit of monetary policy to do whatever it takes to meet our mandate with our tool set. And so, you know, by the way, we are working closely with people who matter, both domestically and international, on thinking about what is the most effective way. Can we're all done? Or, sorry, there's one to go.
Thank you. I don't know if this question's a little bit too simple, but
Oh.
yeah. How much weight did you put on the international environment versus the domestic economic environment in making your decision to cut by 50 basis points?
There's no clear dividing line. We are part of the global economy. So when we're looking at the data, we're trying very hard to understand what is the genesis of the shock or the headwinds we're facing. So what you see here is basically the sum total of that discussion. We can't give you a clear dividing line, I'm afraid.
The international environment is the context that we're operating within, and we have to think hard about how we believe that's evolving, and then how are we bobbing around within that environment, setting interest rates. Okay, I'd like to thank everyone again. I'd like, while you're all just sitting there, just get some energy in the room here, can we just give our Christian College colleagues a wee round of applause for their efforts? Giles, that looked a bit half-hearted, but thank you for the efforts. Your heart was there. Excellent. Thank you very much.